Welcome back, guys. Have another very special guest with me here today. Former mortgage broker extraordinaire, my good buddy Anthony Lisa. You guys have seen him on the channel before. Going to go over some economic data, some things we're seeing, kind of make a few predictions on where things might be going here in the future. Anthony was on previously in December, and a lot of his predictions for where rate cuts were going, for what was going to happen with the debt, the GDP, and even his forecasts about stagflation are kind of hitting us right in the face right now. So I really wanted to get him back on and get his opinion since he pretty much nailed it last time. So first and foremost, Anthony, thanks again for joining me today.
Yeah, thanks for having me back, and thanks for these accolades, extraordinaire.
Well, man, I mean, I went back and I watched our stuff from December, and it was, I mean, all the concerns that you brought up and things you touched on, it seems like we're just sitting in the middle of them right now. I mean, especially now everybody's coming out and like, oh, don't use the R word. It's not a recession, but we may have stagflation, and rate cuts look like they're pretty much off the table, even in an election year. And you were sort of sounding the alarm about this 5 months ago.
Yeah, it was really just the data that was available to us at the time, and it was some of it was based upon moves that the Fed wasn't making at the time when they were choosing to pause rather than doing a justifiable rate hike to really finally put that last nail in the coffin on inflation. And yet, like anything else, when even if it's just a consumer that's saddled with debt, the Fed was trying to play the long game. They're trying to stretch this out, and the longer that they're able to stretch it out, the better chance that they have of pulling off a soft landing. But now it's kind of starting to blow up in their faces a little bit here.
Yeah, and at the time, that's sort of how we felt. We felt like rates needed to go higher. That was when everyone was championing that, oh, it's going to be 6 rate cuts this year, and you and I are like, it's going to probably not be that, and it
Mhm.
needs to go up. If anything, now we get these weak GDP numbers this week, and at the same time, we know consumer debt is absolutely insane. This really seems to be the only way people are hanging on. Um, what's your prospect of the stagflationary environment now that we're almost in it? What are your thoughts on it now?
Yeah, it's starting to come to fruition. You're seeing prices still to continue to elevate. Meanwhile, over the last 3 months, the economy has slowed to a GDP of 1.6%. So those two ingredients right there are strong ingredients to solidify that stagflation very well may be on the horizon, or we may be in it already.
Yeah, we very well maybe, and that's they always go revise data. Everything's looked at in the
Mm.
past, so it's going to be interesting this quarter because we've got everybody getting their tax returns. So
Mhm.
I'm sure that's gonna. I would be surprised if that doesn't help the next quarter a little bit. Um, but yeah, it's things are still going up everywhere, man. And guys, we're not economists. Former mortgage broker, current real estate agent. Anthony is also a real estate investor, so we kind of know we keep track on this stuff. But obviously, nobody knows where it's going to go, guys. Nobody can forecast this, and anyone who tells you they can is lying. But another thing that really bothers me, and I'm sure you as well, is when they put these inflation numbers out that everybody is seeing their bills mount, 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 everything's going up, and they're telling you, oh, deflation or inflation's only 3 point something percent, so it's coming down. That's different than deflation, though, isn't it?
Yeah, it's really a play on words, and to the average consumer who hears the word inflation, that means things are going up, and then you hear disinflation, so in turn you would believe things are going down, which is partially true, but it still means that inflation is there. It's just growing at a slower rate than what it was. So yes, um, we were 9% at the peak, and we've disinflated down to 3 point something, whatever, depending on what the month is. But that doesn't equate to seeing savings on things that you're buying. Prices aren't coming down. Deflation is where the rate of inflation actually goes below zero. And that's where you start to see prices come down and you actually get more for your money at that point.
Yeah, and unfortunately, I mean, at this juncture, it almost looks like those days. I don't want to say they're completely behind us, but it's like, man, going back to 2019 pricing on a lot of things doesn't seem feasible. Maybe some electronics, like things that people don't need. Um, we get that question a lot. Our prices going back there? But I think, and even home prices, I think they're it's just kind of baked in at this point. You know, that's what things are going to cost. Maybe they come down a little bit, but people ask me, "Oh, how can people pay these rents and how can people pay these prices?" But there has also been, and correct me if I'm wrong, as much as there has been an increase in inflation, there has also been some wage inflation to catch up with that.
Yeah, that's the word that you use, baked in, is the best way to describe it, because whether you're talking about homes or you're talking about consumer goods, um, the baked in costs aren't going to be able to, they're only going to be able to absorb that so much. And specifically with consumer goods, we've seen employment have record wage increases, or vice versa. They maybe didn't raise the wage, but they hired somebody that wasn't qualified or meet all the regular qualifications for the job. So in turn, that person did get a raise. And unless we're going to fire the entire workforce and rehire them at lesser wages, these prices can only come down so far.
Yeah, that's a great point too. People who wouldn't have had mobility upwards were put into those positions and also got raises. Unfortunately, it does create two economies here. We've had people who their wages have not kept up, and the prices have kept going, and they are really hurting. On the other end, we've had people who have made big gains in their wages, or now just recently, because the stock market hit all-time highs again, Bitcoin hit all-time highs again. You've got people who have just got a huge influx of capital for the second time in 4 years. And that really concerns me, because it's like we spent 2 years trying to get this money out of the economy. And with all of these gains, is it coming right back in, especially in the luxury market?
Yeah, for sure. I mean, it's no secret in the news lately. We've seen $1 million plus properties having continued to appreciate in value, and the number of all cash sales on those is staggering as well. So these are the types of people that made their gains, maybe for the second time around, as you said, and now they're taking that money and putting it into a hard asset, like a luxury property. And that money is putting them in the driver's seat. They're not interest rate conscious because it doesn't apply to them, or they're taking out such a small loan that, in their bracket, it doesn't really affect them. But yeah, it's like a continual printing press, this crypto market and stock market.
Yeah, yeah, it's wild to just see it all go off again, and then on top of that, people have these gains and this inflation's going on, and we're watching the treasury yield increase, and everyone's like, well, what's going on here? And when you look at, I think you had given me the stat that the government is still spending like crazy. I think you were telling me, or I read somewhere, that it's to the tune of like $1 trillion every 90 days. And I remember when we last spoke on here, that was also one of your biggest concerns, was the government debt.
Yeah, it's a real problem. As we pointed out, by the year 2026, it's going to be the government's number two line item expenditure, second only to Social Security. And that 90-day figure is actually on a sped up timetable now. And every month that goes by, the debt is compounding faster now, and so it's speeding up. So eventually, it's going to be every 89 days or whatever. So and in comparison, now you mentioned the treasury yields surging lately. We got the GDP number where we're at 1.6% for the first quarter versus the 2.5% expected, and down half from the fourth quarter of 2023, where we were at 3.4%. So that number would really be indicative of giving the Fed traction to say, hey, the economy's slowing down, and you would indicate maybe that they would be able to make a rate cut. But the treasury yields are working in opposite, because they're recognizing the debt load here, and what the government is continuing to spend.
Yeah, it's crazy. It's almost criminal. I'm sure a lot of people on here feel that way. And when we had last chatted, like I said, the six rate cuts were coming in 2024. We kind of called BS on that. At this point, some people are even starting to talk about a rate hike. We're in an election year, obviously. Pie in the sky. Where do you see the rest of this going? Do you see rate cuts happening? Do you see us at 8% mortgage rates? What if you had a crystal ball, just to say, what would you think the remainder of the year would look like?
You and I have been in the same camp from the get-go that we kind of felt like 8% was the number where we needed to get to in order to correct the economy as a whole, both from the housing sector and also, with inflation. I mean, at this point, we have to start to wonder what the implications would be if they actually had to turn around and do a rate hike now, if things start to get out of control again with inflation. In my opinion, I don't see any rate cuts happening until the November meeting. The November meeting, I believe, is a day or 2 days after the election.
Wow.
So it kind of takes them out of the equation. They don't want to seem like they're influencing it one way or the other. So they're going to do everything they can to not, even though they said they wouldn't let it affect their decisions going forward. But I think it weighs on their minds. However, Jerome Powell has been pretty clear throughout the process that the rate cut is going to come one of two ways. Once they have confidence that they have a hold on inflation, or if their current policies becomes too restrictive for the economic environment. And I think we have a better shot at seeing the rate cut from over restriction at this point, rather than from us winning a battle against inflation.
Okay. Yeah, I agree with that, and I don't know if it's scary what they're going to consider as a over correction on their end, because I do think with that GDP reading, with everything that we're seeing, I think the rates and the concept of higher for longer is really starting to take a hold. I mean, I know people that are holding off on buying houses because the rates are too crazy, though I don't think they're going to get much better. I know people who are refusing to even entertain a car purchase. A lot of people are kind of on the sidelines with those two products. But at the same time, we have credit card debt skyrocketing, mounting, just going absolutely insane. And there's going to be we've always wondered, where's the threshold? Where is the end of the road for the consumer? And I'm wondering, and you've spoken about this, and you can speak about it. You've kind of laid it out as it's a top-down thing. Is this the end of the road? And then, if the consumer hits the wall, how do we see that really start taking effect on all aspects of the economy?
Yeah, I think we all underestimated the amount of money that was out there and that was available to everybody, and also underestimated the willpower of the consumer spending. It just seems to have no end. But I feel like we're finally getting there. The money for sure has dried up. Now the credit that we've talked about with credit debt at all-time highs, I think that is starting to dry up. Maybe it's still available, but it's becoming so expensive. It's at this point it's not feasible for them to even do it because of the cost. So we've dried up. So now the consumer spending has no choice but to slow down. And now that's being reflected in the GDP going down to 1.6%. So this could be the precursor of things to come. The money's dried up, the consumer spending has stopped or slowed down in comparison to what it was. Now the next phase, if it persists, is production going to slow down? Companies aren't going to need to produce or put out what they've been putting out. Are layoffs going to follow? If so, unemployment's going to rise. If unemployment starts, now there's even less money being put into the economy because people's disposable has just been shortened. So it's a trickle down effect, and we could be starting to see the beginning stages of it.
Yeah, great point. And we may be in it, and like when they revise backwards, we may already have been in this, because
Yeah, sure.
that's all we hear about constantly is layoffs. Now they're not massive, and we see the job numbers increase, but then you dig down into them and they're like part-time jobs and not a lot of full-time being created. I do wonder where these laid off employees are all going if they're not going on to the unemployment roll, or if it, and it doesn't count people who stopped looking. So it's going to be interesting when we to look back at our last broadcast and then to compare and contrast, like where are we going to be in 6 months? Are we going to be looking back and with just like oh, we this was all there in front of us and it was just not portrayed that way.
Yeah, it's really a tough scenario that the Fed is finding themselves in, because in one sense, with where the GDP numbers are, like I mentioned, that would generally be indicative that the economy is contracting and almost start to constitute a rate cut. But yet at the same time, if prices are edging higher, they can't risk cutting rates and starting inflation all over again. So it puts them in a pretty tough situation. And the one thing that I found the most strange is Jerome Powell has played everything prior to this pretty close to the vest. He was very, very coy, very non-committal about going forward.
Yeah.
Just because he was he was conscious that when he speaks, the markets react. So, but it seems within the last couple months, he's been very forthcoming with information, almost a little too much. And I'm kind of wondering if that's a recognition in itself that we have bigger problems on the horizon.
Yeah, one of our many bigger problems right now.
Yeah.
Yeah, they keep just continuously adding up. So, but yeah,
Yeah,
man,
in my opinion, I thought he was going to deny rate cuts right up until the day that he actually cut the rates. And,
yeah.
And then here we are recently, charting a path forward with what was originally 6 cuts anticipated down to 3, and we'll find out at the next meeting what the new path is going to be charted at.
Yeah, and people will maintain that Powell has never said any of this stuff, and a lot of it was the media pushing this. But he had come out several times, and I mean, I think the biggest thing that hurt us was when he said, "We may not wait for a 2% inflation target to consider loosening policy." I think that was a big killer, and kind of since that point, I think that has sent people into a delusional frenzy. Well, that's what we got for today, guys. Anthony, thank you so much for joining me again. Really appreciate you coming on.
Anytime, Ben. Looking forward to coming back again.
Absolutely, my friend. And guys, if you like this video, give me a like, share, subscribe, and we'll see you next time.